All right, let's jump right into this explainer. We're going to uncover the vast, hidden ecosystem of consumer finance. When we think of financial institutions, we usually picture giant banks with marble columns, right? Or just the credit cards we swipe every single day. But there's actually a massive, multi-billion-dollar shadow network operating right under our noses. It's basically the plumbing of our daily financial lives, working silently in the background. So today we're unpacking exactly how this unseen machinery works, and more importantly, how it's held accountable in an era where data is literally just as valuable as currency.
So, what exactly is consumer finance? If you instantly thought of revolving credit card debt, hey, you wouldn't be wrong. Historically, that has been the largest segment. But the industry is actually way broader and, frankly, a lot more complex than just that. It touches almost every aspect of how everyday people borrow, move, and manage their money, completely outside of traditional banking structures. Actually, scratch that. It doesn't just touch it. This alternative ecosystem serves more people in their day-to-day lives than traditional Wall Street banking ever could. We rely on it constantly, usually without even realizing it.
We are talking about a massive web of alternative services here. Think about the auto loans that get you to work every morning, the student loans funding higher education, or micro-lending platforms. Those are absolute game changers, bridging the gap for small entrepreneurs who simply can't get a traditional commercial loan. And it doesn't stop at lending. It's consumer-to-consumer money transfers, literally vital lifelines for families sending money back home. It's prepaid debit cards. It's the digital bill payment services you use just to keep the lights on. Millions depend on these specific alternative services every single day, sometimes without ever stepping foot inside a traditional bank. To see exactly how these companies are held accountable, we're going to look beyond just credit cards, examine the accountability scorecard, and dive into how they protect customer privacy, secure financial data, and practice responsible selling. And finally, we'll wrap up with how all of this is actually measured. All right, Section 1, beyond just credit cards. Let's look at the unseen risks operating just beneath the surface of this alternative finance landscape. Because these alternative companies handle massive volumes of both highly sensitive data and hard currency, they face some incredibly unique operational risks. Before standardized scorecards existed, this industry could often feel a bit like the Wild West. Investors and regulators couldn't easily tell a highly secure money transfer app from a house of cards just waiting to collapse. So to evaluate these unseen risks, analysts now turn to the SASB standards. This is an industry-specific accountability framework now under the stewardship of the IFRS Foundation. It provides a really rigorous way to look under the hood. It essentially tells us whether the company processing your remittance or holding your student loan is actually managing their risks properly, and that affects their survival and, for sure, your security. Moving right along to our next section, the accountability scorecard. Let's break down the 3 pillars of disclosure. So how exactly does this scorecard bring order to the chaos? Well, the SASB framework systematically grades consumer finance companies across 3 critical disclosure areas: customer privacy, data security, and selling practices. Now, these aren't just abstract ideas getting tossed around in boardrooms. For a company dealing in, say, peer-to-peer lending or digital prepaid debit cards, failing in any of these 3 areas has devastating real-world consequences. We're talking massive class action lawsuits, crippling regulatory fines, and a total loss of consumer trust. And in the alternative finance world, trust is literally the only currency they have. If users don't trust an app to transfer their rent money safely, boom, that business vanishes overnight. Okay, let's dive into the first pillar, protecting customer privacy. Ultimately, this asks, how is your data being used? The foundation of that trust really begins with what happens to your personal information the second you hit submit. Think about the incredibly detailed demographic, behavioral, and location data you hand over when setting up a new bill payment service or a money transfer app. A major concern for everyone, investors and consumers alike, is whether companies are taking that account holder information and using it for a secondary purpose without proper consent. Imagine you use a specific app strictly to pay your utility bills, right? But suddenly, out of nowhere, you start getting highly targeted text messages for high-interest personal loans. That happens when a company uses your data for something completely unrelated to why you originally gave it to them, like serving you targeted ads or, even worse, outright selling your personal profile to a third-party data broker. And that is exactly why strict metrics exist, to hold these firms' feet to the fire. Take metric code FNCF 228.1, for example. This is a direct mandate from the SASB framework that forces companies to hand over the exact number of accounts used for these secondary purposes. But, it actually goes deeper than just a single number. Companies also have to shed light on their opt-in policies. Do they require explicit, freely given consent that you actually understand? Or is that permission just deeply buried in a 40-page terms of service agreement, way down in the fine print? If a company relies heavily on quietly selling data from its prepaid debit card users, well, that represents a massive regulatory trapdoor that investors absolutely need to know about. But, of course, a strict privacy policy is absolutely useless if the digital vault is left wide open. Which brings us to our next critical area: securing financial data, guarding against breaches and fraud. In the modern world of alternative finance, physical cards are just becoming less and less relevant. For things like online bill payments, virtual prepaid cards, and instant money transfers, card not present or CNP fraud is a massive liability. This is when someone uses stolen financial details for an online or phone transaction where no physical card is ever actually swiped. Now, unlike traditional banking where a stolen physical card can often be easily flagged and confiscated at a retail register, CNP fraud in alternative finance moves at the speed of the internet. It can completely devastate consumer confidence and lead to incredibly costly litigation for the financial institution left holding the bag. So the standard demands absolute transparency on all these data security fronts, ensuring companies aren't just hiding their vulnerabilities behind slick PR statements. I mean, they can't just release a memo saying, "We take your security seriously" anymore. No way. They have to disclose the hard numbers. Exactly how many data breaches occurred this year? What percentage of those breaches actually exposed real people's personal data? How many unique accounts were compromised? And what was the actual dollar amount of losses from card not present and other types of fraud? This ruthlessly separates the companies with genuinely robust cybersecurity from those that are essentially ticking time bombs. And the thing is, the threats are constantly evolving. Under metric FN CF 230A.3, consumer finance companies must also describe exactly how they tackle complex modern attack vectors. It's not just about simple hackers guessing passwords anymore. Companies have to detail their defenses against sophisticated ransomware. They also have to combat loan stacking schemes, which, if you aren't familiar, is when a borrower fraudulently takes out multiple alternative loans from different lenders at the exact same time, right before the credit bureaus can update. They even need to outline strategies against money mule schemes, where criminals use innocent people's accounts to funnel illegal funds through consumer-to-consumer transfer apps. If a platform can't explain its defense against these specific threats, that is a huge red flag. Even if a company protects your data from hackers, the next question is, are they protecting you from themselves? This is the core of our third pillar, responsible selling practices. Are products truly in the customer's best interest? This really asks a fundamental question. Are these alternative finance companies genuinely serving their customers or just their own short-term bottom line? A really critical factor here is variable remuneration. This simply means employee pay that is linked directly to sales volume rather than a fixed-base salary. And, because human behavior is heavily driven by incentives, this can be super dangerous. Imagine a scenario where a loan officer's end-of-month bonus depends entirely on hitting a quota. They are now highly incentivized to aggressively push a vulnerable customer into an auto loan they clearly cannot afford, or steer them toward a high-interest payday loan simply to get that variable payout. To combat these deceptive or aggressive practices, companies must disclose key characteristics of their lending portfolios. They have to reveal their approval rates, the average annual percentage rate they charge, and exactly how much money they're squeezing out of customers through average fees on add-on products. Think identity theft protection and things like that. They also must disclose the average age of their credit products. This one is vital. Why? Because if customers are quickly abandoning a company's microloans or closing their prepaid cards after just a few weeks, it's a massive warning sign that those products are either predatory, riddled with hidden fees, or just plainly unhelpful to the end user. The standard also holds these institutions directly accountable to the public's reaction. Metric FN CF 270A.4 explicitly tracks the number of official customer complaints filed with regulatory agencies. The scope here specifically hones in on those alternative services we've been highlighting all along: complaints regarding payday loans, student loans, vehicle leases, and money transfer services. Furthermore, they must disclose what percentage of those complaints actually resulted in the customer getting monetary or non-monetary relief. Basically, this shows whether a company actually makes things right, like issuing a full refund or permanently reversing a predatory late fee when they get caught crossing the line. So how do analysts take all these disparate risks, from data breaches to aggressive sales tactics, and actually make sense of them? That brings us to our final section, measuring what matters. The ultimate goal here is translating qualitative ethical concerns into hard, quantitative financial metrics. Look, you can't put a simple number on a broad concept like ethics, right? But you absolutely can measure monetary losses from legal proceedings due to privacy violations. You can measure actual dollars lost to card-related fraud. You can count the exact number of customer complaints filed over aggressive selling. This framework essentially forces alternative finance companies to put their money where their mouth is, giving analysts the concrete data they need to compare these companies side by side. Finally, none of these numbers mean much in a vacuum. Think about it. 10 data breaches at a tiny neighborhood microlender? Absolutely disastrous. 10 breaches at a global money transfer service processing billions of transactions? I mean, it's still bad, but the context is vastly different. By looking at standardized activity metrics, like the sheer number of unique consumers or the total volume of active prepaid debit card accounts, analysts can normalize all that disclosure data. This provides the vital context that stops numbers from lying, scaling the data against the true volume of operations to paint a complete, highly accurate picture of a company's actual risk profile. So we've seen that the consumer finance ecosystem is so much more than just a traditional bank or a piece of plastic. It's the auto loan that gets you to work, the microloan that helps start a business, and the digital bill payment service that keeps your lights on. The next time you send a money transfer to a relative or check the balance on your student loan, ask yourself, is this company truly safeguarding my financial data? Are they actually selling me products in my best interest? And most importantly, who is holding them accountable behind the scenes? Thank you so much for joining me for this explainer, and keep asking the right questions.